And welcome to the Prescribing Prosperity Podcast with John and Alex Soutsos. Gentlemen, oh, how I love today's topic. Good to see you.
Likewise, Bill, good to see you too. And we hope to shed some light on the subject of the AI bubble.
Oh, yeah.
Is there an AI bubble or is there not an AI bubble?
I don't know. I mean, we're recording this, is it middle of fourth quarter, 2025? The markets have been anything but stable, shall we say?
The day before Thanksgiving is where we are. Important day for you.
I know. I'm a day before stuffing myself into a coma here.
I hope you're on a hunger strike right now, Bill. You got to do your prep.
I've been on one. I actually, over the last year, I've lost over 30 pounds, but I'm going to gain it all back tomorrow. So, you know.
Don't be a rookie. Don't wear like tight jeans or anything. Wear sweatpants.
No. This is total relaxed sweatpants and everything else. Exactly right.
Got to be smart about these things.
Suddenly, somewhere along here a few weeks ago, somebody woke up and screamed AI bubble, and it freaked the markets out. Yeah. Understandably in some ways, because I remember, the panics in the late 90s with the tech bubble. But John, you have a decidedly different perspective to offer today to those people who are thinking, "Oh man, this is all an illusion. It's all not real, and it's time to freak out and get out of the market."
Generally, when it reaches this stage and people are running around with their hair on fire, there's no bubble at this stage, because in order to have a bubble, you have to have everyone on one side of the argument. It's going up. Nothing's going down. We're going to the moon. That's what a bubble is. Okay. When you have CNN's fear and greed index at 11, there's a healthy dose of skepticism. And the AAII sentiment survey also is equally pessimistic. So when you have such a large cohort of the investment community believing that there is a real risk, then that risk really is not urgent. Let's put it that way. Mm-hmm. As the old adage says, the stock market climbs a wall of worry. So as long as there's a wall of worry, there's an opportunity for gains. But the whole AI bubble discussion or narrative is not a November issue. This conversation has been going on since the DeepSeek announcement in mid-February. That's month 2 of 2025. We are now in month 11 of 2025.
Well, it actually even started before that. I believe the first mention of an AI bubble started back 3 years ago. When NVIDIA and some of these other microchip and GPU companies started to really see their valuations explode. And so there's been talk of a bubble for going on 3 years right now in the stock market. And so to say that it is just a recent phenomenon is not accurate, and so, to a certain degree, speaks to the real lack of a bubble.
I would definitely agree. And feel free to chime in, Bill, as you see fit, because you and I are of a similar generation, and we went through the dot-com bubble in the second half of the 1990s. And I can tell you, from my vantage point inside of the investment community, the way investors are behaving today versus the way investors were behaving back then is vastly different. And the corporations that were involved in the dot-com bubble are very different than the corporations today. And one of the primary differences is corporations today actually have earnings. Mm-hmm. And
they actually have a spreadsheet you can read and look at and not freak out over. Yes, that's true.
It's not pets.com with a hope and a prayer. It's real businesses with real earnings. And I have to remind everyone that Amazon actually had a viable business before 3 years ago.
Right. Thing is, John, I mean, just to talk about that for a second, I think a lot of people are hearkening back to that because there are a lot of people who were not in the market then, but they look and see what happened and they see the destruction of value and how it took a while for the market to come back from that. So they're thinking, I don't want to play in this. I don't want to be a part of this. And then they look at the valuations of the stocks that you today, and they're saying the valuations are just simply way too high, and maybe this is right. I mean, it's a perfect recipe for fear. I can understand why there's fear in the market.
Without a doubt. But you can't simply look at a headline or listen to someone. Now, today the media is beyond the legacy media, as we all know. In the 1990s, it was essentially the legacy media in all of its formats. Today we have so many people involved in the media. You have podcasters, you have people who are blogging, and you have YouTubers.
Yep.
So all you need is one group of people or even an individual to start screaming fire in the theater, and everyone's in a panic and they want to get out. And what I find interesting is that when my own clients, so I'm a portfolio manager, you would think that people would understand that I have some kind of insight into what's going on in the market.
One would hope, yes.
And perhaps I do a little bit of research. When my own clients contact me and say, by the way, did you know? And I don't say that to belittle my clients. I understand their concerns and their fears. But yes, we do know. It's our job to know. It's our job to understand the currents in the market, the geopolitical environment, the economic environment, the trends in the market, what's working, what's not working. So yeah, we're very much aware of this. So I get these messages, did you know that Jamie Dimon said this? Did you know that
Michael Burry has shorted a significant portion of the AI market?
Yeah. So, people say a lot of things, and what investors need to understand is people who are in the public eye and say certain things about markets or individual securities, you don't know what their motivation is.
Thank you, John.
You don't know if they're going long, if they're going short. You just don't know what their motivation is. So this is why CNBC, BNN here in Canada, and all these other financial shows that we often refer to as financial porn, you can't listen to the talking heads. It doesn't matter how good or highly respected the portfolio manager is. They're coming on and they're saying, yeah, we love this stock. Well, yeah. Why do you love it? Because you want the price to go up so you can sell? Or we hate this stock. Why do you hate it? Because you want it to go lower so you can buy it? So you just don't know. You don't know what the motivation is. And this is all critical to understand.
Yeah. And I think what also is important to understand is, so going back to what you said at the beginning, in order for there to really have a significant bubble, you need a unanimity of perspective on one side of the ledger in order to try and push momentum significantly in one direction. So you need either a significant, everybody's on the buy side, which drives up an incredible bubble in terms of pricing and valuation, or vice versa. You need everybody on the sell side to then completely crater valuations in a short period of time. And the reason why I brought up the point about, people have been calling for a bubble for the last 3 years is to show that it hasn't just been a consistent, everybody's been positive, everybody's been negative. There's been ebbs and flows in the market over that entire time. I think people forget that we've had multiple corrections during that time. It's not like between 2022 and 2025, it's been a straight line up or a parabolic return up to the moon. We've had corrections along the way. And those are important caveats when you're trying to ascertain as to whether or not you've entered a bubble. One of the other things that I think is important to understand too is bubbles do not occur just because valuations are high. A high valuation alone is not enough of a catalyst to say things have to go down because valuations are high. There has to be something else that causes an intrinsic change in the economy, an intrinsic change in the economic circumstances surrounding that business in order for the valuations to change. The valuations don't just change because everybody said, oh, it's time for them to change.
But it is true. I just to jump in here on the valuation, because you read my mind, I think, a little bit, Alex, in the sense of there is a common theme I don't want to call it a narrative. Let's call it a theme or discussion out there that, like, hey, valuations are insane. We've never seen valuations like this in the market before. And so, I mean, to some extent, John and Alex, that is true.
Mm-hmm.
Why, John, does it not worry you as a portfolio manager?
Well, first of all, as a portfolio manager, we're not committed to any particular investment theme on an indefinite basis.
Right.
So right now, there's profit opportunity in several companies that are involved in the AI, in the growth of AI. And so we're looking at these companies closely in terms of their valuations, in terms of their rate of growth. And as long as it makes sense, we will participate. When the intrinsic metrics change and relative strength changes, we don't have to hold on. We can exit.
Yeah.
And this is the important thing to understand in our service. Unlike ETFs that replicate a particular index, let's take SPY, for example, we don't have to buy the top 7 or 8 mega cap stocks on the market. We can pick and choose who we like. And truthfully, in our portfolio, if we look at the mega cap 8, which is the Magnificent 7 plus Broadcom, if you look at those top 8 companies, we own half. So we're not in every one. We're in the ones that we like. And we can change that. Now, one good indicator we're not in an AI bubble is Berkshire Hathaway took a position in Google.
Mm.
Their biggest position is in Apple. So they own 2 of the mega cap 8. They have a 22% weighting of the public equities in Apple. Really? Do people actually think that the portfolio manager, who's no longer Warren Buffett, do they really think that the portfolio managers at Berkshire Hathaway are that stupid that they're going to allocate a 25% in Apple and just as there's a bubble being blown up? I don't think so. Or initiate a position in Google in November of 2025. I think that we underestimate the people who are making decisions. And so they're certainly not speculating. Now, let's take a look at valuations quickly.
Mm-hmm.
A lot of individual investors or casual investors think that the PE, the price to earnings multiple, is the primary determinant of valuation. And it is certainly an important component of valuation. It's not the only one. It's not the only metric, and you can't make decisions solely on that metric. The more important metric, and Peter Lynch identified the PEGI ratio, price earnings multiple divided by growth plus yield, making it PEGI. So when you start now, in the case of NVIDIA, there is no yield right now, and not at least a dividend yield. So it's PEG. The PEG ratio for NVIDIA is 0.76, which is considered a good PEG ratio. It's considered a ratio that shows that NVIDIA is not overvalued. Now, that is dependent on the growth rate of NVIDIA. So quarter to quarter, we got to monitor that. But as of today, it's not a crazily overvalued model. Likewise, if let's take a look at Amazon very quickly and get their ratio. Their PEG ratio is 0.86. It's under 1. Okay, so Amazon, and by the way, while I name some of these companies, I'm not giving investment advice. Unlike the people on CNBC or Kramer, I'm not screaming you should buy these stocks because we don't know what your financial circumstances are. We might today believe these 2 companies are worth investing in, but that might change next week. So anyone listening to this podcast, we don't want you to start running out and saying, oh, John said, or the boys at MedWealth said. No, we don't want you to do that. But today, I'm just citing 2 examples of 2 of the Magnificent 7 stocks whose valuation metrics, according to their rate of growth, are still quite good.
Provide some context. What is a good PEG ratio?
Anything under 1.0. And for a growth company, anything under 2.0.
Which both of them are.
Both of them are, yes, definitely growth companies. As I said, Amazon had a viable business before AI. NVIDIA had a viable business before AI.
I think people forget that NVIDIA's been around for like 30 years.
Yeah, exactly. These are not new companies.
They make it out like they're fly-by-night organizations who just came out of nowhere, but that's...
Yeah. It's not pets.com.
Yeah. It's not pets.com. It's not stamps.com. It's not, we're not valuing them on price to clicks, price to views, or any other nonsensical valuation
It's
metrics.
not billtucker.com.
Well,
wait.
He's got a new hip. He's a new man now.
John, it's really funny you're talking about valuations at Amazon, and I've put in NVIDIA. Two real quick confessions here. I was working, as you all know, I was working as a business financial news reporter, and I was definitely covering the tech market bubble back in the late 90s. And I remember a coworker who had quite a significant number of shares in Amazon, and they'd gone up he at the time, I think, had gone up like fourfold on him, and I remember telling him, man, you really ought to sell. He goes, why? I said, didn't it freak you out? I mean, you're up fourfold on this stock. You've already made a really nice profit. Does it ever keep you awake at night? And he was like, no. In fact, I think I'm going to go buy more.
Good man.
And to my knowledge, he never sold that Amazon. He held on to that Amazon.
Oh, you did take a hit at one point.
Well, yeah, he did take a hit at one point, but I mean, who looks silly now? In terms of the advice. And in NVIDIA, I owned NVIDIA, and I had the threefold increase since I bought it, and I thought, I'm freaking out, and I sold it because I just lost my nerve. I sold it, and I spent a year, guys, thinking, why did I sell that stock? Why did I get rid of that stock? The fundamentals are great. What it's doing is great. Everything about it is great. Long story short, I went back in, and full disclosure, I own NVIDIA.
But Bill, this is what the financial press and traditional thought when it comes to investing tells you: buy low, sell high. So once a stock runs up, you say, "Oh, it's time to sell it."
Yeah.
Well, no, it's not time to sell. It's time to reassess. You need to constantly reassess the rate of growth, reassess the financial metrics, and then you make that decision. And in fact, if you have a good stock that's running, you got to let it run. You got to let it run. As long as the relative strength is there, you got to let it run. And that's how you make money, because you're not always going to, companies that are trading at a low price don't necessarily mean they're good value. Yes, they might qualify under value metrics. And I can tell you there's a whole bunch of value managers that have been twiddling their thumbs for the last 20 years that have made next to nothing, right? While the growth managers have been having their breakfast, lunch, and dinner. And they say, one day that whole thing's going to pop and
come undone, by golly.
They'll see. So the funny thing is there's a portfolio manager in Philadelphia that we know quite well, and he's a very, very funny guy. And he's a value manager, but he does it a little differently. So he does actually make money. Anyway, he tells a story.
He does it with style.
He does it with style. He tells a story about Apple, and he bought Apple early on, and so he pauses. He says, "I bought Apple when it was $2 a share," and so people, "Oh wow, yeah, $2, wow, that's amazing." He says, "Unfortunately, I sold it at $4." So there you go. It doesn't matter, right? What you bought it at. It matters what you sell it at, and you got to know when to sell it. Just because the stock goes up doesn't mean it's overvalued. No, it's not necessarily overvalued. It depends on its rate of growth. So you always have to look at the rate of growth, and you have to look at return on equity as one of the metrics. You have to look at year-over-year growth of earnings per share. You always, and debt to equity ratio, and there's a variety of financial metrics you got to look at. So simply opening up your cell phone in the morning and saying AI bubble in a news article doesn't mean that's how you assess your next decision on your investment portfolio. This is where professionals come in, and you need to consult with professionals. Professionals are not the people who do podcasts on social media and make fun of the current president as their meme for entertainment. You have to listen to people who know, okay? Because there's a whole bunch of people who don't know and have an opinion.
Yeah, well, no, there's no shortage in this world of people who have opinions. There's absolutely none of that. But what I'm curious about, John, and maybe you can address this, is the one thing I think is a legitimate fear is leverage. People talk about the leverage in the market. And and there was leverage back in the late '90s. There was also leverage around 2008 when we had the collapse, the financial collapse there. I mean, what does leverage look like these days to you? And is it a factor that bothers you?
It is leverage is an issue. There's a lot of leverage in the market right now, and it's not just traditional margin leverage. This leverage is in the form of option contracts. So, as you know, with an option contract, you're leveraging every dollar you're utilizing, and when you have a whole bunch of people on one side of the trade saying market's going up or ABC stock is going up, and they're all full of call options, then yeah, leverage is an issue. So leverage is always an issue in the market. You always have to be sensitive to that, but this is where portfolio construction comes in. So our view is not that AI today, the companies involved in AI, there's some good opportunity there. It's not uniformly good. They're not all good.
They're not all the same, right? Exactly.
And so we're sensitive to that. And if relative strength changes, we will make an adaptation. But Alexander, why don't you go through for us the anatomy of a bubble?
Yeah, and I think that's exactly where I was hoping we were going to go with this, because I think that understanding what the structure of a bubble is and the context behind a bubble is really important. So first of all, let's get one thing out of the way right off the bat. Bubbles are incredibly rare. The people who are out there clamoring like Michael Burry every 5 minutes about a bubble. By the way, nobody should really. I understand that he called the real estate market correctly, but Michael Burry goes off like a broken clock. He's right, twice in a 24-hour span. Like it's not exactly a reliable source of information in terms of what is happening in the market. So I don't think people should get overly fussed about that. But if you look at the history of how often bubbles occur, they occur less than 0.5% of the 3-year period since 1790.
Oh man, that's fascinating.
We give it. You use a 3-year period because the average, full market cycle is between 3 and 5 years. So if you look at all the 3-year periods that have occurred since 1790, less than 0.5% of them have had a true market bubble in them. And so it's important to start framing your narrative or framing your understanding with that in mind, to say, okay, this is not an everyday occurrence. It's not a once in a decade occurrence. We've had 2, bubbles in a relatively short period of time in the last, 25 years. But that is uncommon for it to occur that frequently. So let's go through the anatomy. So first of all, you need an initial catalyst. It begins with something that stimulates initial buying. So usually it can be a technological innovation. It can be really low interest rates. There has to be something which triggers people to buy in large quantities to begin with. Then what you need is a positive feedback loop to occur. So, prices rise. People scramble to buy more before the prices go up. And then before you know it, the prices continue to increase because you get the increased buying and the increased demand. And so it kind of levels up. Yeah, you get but that's the next one. So then you get the exuberance. And this is where FOMO really comes in, the fear of missing out, where people become so worried about jumping in on this trend that the prices become detached from their fundamental value. And speculative behavior starts to ensue, and you have the so-called get-rich-quick schemes. I'll give you an example with that. When I was a kid, late 90s, early 2000s, everybody and their cousin wanted to buy a Tim Hortons franchise. I think I've given this example on the podcast before. But everybody was talking about, I'm going to open up a franchise and overnight I'm going to be a millionaire because look how many of these franchises are popping up. I'm going to make all this money. And at that point, it was already over. If the average person is talking about it and saying, I'm going to use this to get rich really quickly, that's it. It reached its peak, its zenith, and it is likely to try and to start to turn in the other direction shortly thereafter. And then finally, that's where you get the burst that happens. There's another catalyst that causes prices to fall, whether that's a change in economic circumstances, which leads to panic selling, or something that changes in the macroeconomy or in the specific business or industry that the company operates within. That's where you need some fundamental change to occur. And that's why I said earlier, prices don't come down just because they're too high. prices can elevation or valuations can remain elevated for years at a time. Bubbles last on average a year and a half, and the correction is not always an imminent. You hit the year and a half mark and there it is. It can be 5 years in length. Alan Greenspan, I don't know if you remember this, Bill. You probably do. In the mid '90s, 1996, Alan Greenspan comes out.
Exuberance.
Yeah. When did he? That was in, if I'm not mistaken, August of 1996. Anyway,
right,
it was
somewhere there. Yes,
1996 for sure.
It's a few years early.
Yeah, he was more than almost 4 years early. And so, him calling the valuations extremely elevated, and there was a rational exuberance back then, that didn't even, prick the bubble and cause it to come back down immediately. And so you have to understand that the bubble, the anatomy of a bubble, there are certain things that have to be in place in order for it to really manifest itself. And as of right now, we do have some of the elements, but we're lacking some of the other key elements that exist in the bubble. As I've said, we've had ebbs and flows in the market over the last 3 years that wouldn't suggest that there really is an irrational exuberance that is occurring, to borrow Alan Greenspan's terminology.
The thing is about this whole narrative is the term bubble is being tossed around like copper pennies. It's a worthless term like copper pennies, used to describe a market that is expensive. So, as Alexander said, markets can be overvalued or undervalued for extended time frames, years.
This is all normal market behavior is what we're looking at.
Yes, it is totally normal. The market operates in a range, a trading range, typically plus or minus 3% from the curve,
Historical mean,
the historical mean, the trend. And periodically it'll go above or below that, and this is just normal. But now, because of the sensationalization of media, they can't just use the term overvalued. Now it's got to be a bubble, right? And this is the problem. It's like the term fascist. It's lost its meaning because everyone tosses it around. It doesn't mean anything any longer. Right. So we need to be careful with this terminology. Yes, markets are on the expensive side. Yes, certain companies are very expensive, but a lot of the key players in the current AI phenomenon are not ridiculously expensive as long as their growth continues. And right now, I cited 2 illustrations where growth is continuing. There's a backlog, a substantial backlog. Jensen Huang, I'm not sure how the correct pronunciation of his surname is, but the NVIDIA CEO is not a stupid man. He's been running that company for 3 decades, and he's taken it from nothing to the biggest company in the world.
The other thing to keep in mind, Dad, is valuation alone is not a good prediction of return. So we talked about this in our last
no, absolutely not.
Prospect presentation. If you actually did a regression analysis, which we have. If you look at the trailing PE ratio and you compare that to the performance of the particular security or of the S&P 500 a year later, the PE ratio as a predictor of the return, the 1 year rate of return, has an R squared value of 0.01. If you are anybody who understands how statistics work, the higher the R squared value, it ranges between 0 and absolute 1. The higher the R squared value, the better a predictor it is of the independent variable. So in this situation, the trailing PE number, the trailing PE ratio is a very, very poor predictor of future performance of the S&P 500. And so just by looking at valuation alone, you're unlikely to get a clear picture as to whether or not the stock's price is going to be materially better or worse in the following year. And so that's where, as I said before, you can't rely exclusively on valuation and say, well, valuations are high, therefore we need to have a correction.
What I'm curious about is if we can move to this, I don't know if you want to move there right now, but I would love to hear your arguments against AI not being in a bubble.
Let's begin first with the whole technological innovation cycle. And so we've gone through this in the last 200 years. You have the railroads that everyone remembers first, electricity, oil, telephones, washing machines, cars, et cetera, right up until the present day. And typically, and by the way, part of that technological revolution are pharmaceuticals. So they're a 20th century innovation. They didn't exist in an organized fashion prior to the 20th century. So every innovation has that initial infrastructure build, and that typically results in a small group of companies spending amongst each other, which is what by the way, this whole AI bubble thing is based on an MIT paper. I don't know if we mentioned that earlier. Are you familiar with that paper, Bill?
No, I'm not.
No. Okay. So MIT produced the research report, and they're the ones who talked about circular funding. And there was a great diagram that Bloomberg put in the press. And this is all what has created the fire that we see in the media today about an AI bubble. They're saying, look, there's only a handful of companies that are involved in this, and there's a nice pictographs showing NVIDIA in the middle, and around it as satellites, you have Microsoft and CoreWeave and Nebius and Oracle and Nscale, AMD, et cetera. And so this MIT paper lit this on fire. Now, why is it that only the MIT paper was circulated in the broad media? There was a rebuttal to the MIT paper by George Mason University, by their think tank. Think it got any press?
No.
Zero. George Mason University is a libertarian-oriented educational institution, unlike MIT, which leans to the left. So unfortunately, a lot of this conversation, it goes back to the whole left and right paradigm. And so you get an element of that going on. But getting back to the history, the infrastructure build having a small number of participants is totally normal based on historical precedent, on technological innovation. Then you need, in order for it to go to the next step, you need adoption. You need the innovation to be adopted by the consumers or producers, whoever is utilizing the technology, in order to justify the initial spending and to allow this to grow into mainstream and persist for an extended time frame. And so, as we know, as time has gone on, what has happened is the adoption cycle has become shorter and shorter. So, for example, if you look at, I'm looking at a graph here, railroads took, electricity took something like 40 years to get to a viable place. Railroads took, forgive me, I'm looking at a funny looking diagram here, but it's like 30, 40 years. But every cycle after that became shorter and shorter and shorter. And now the adoption of artificial intelligence is 2 years.
I challenge any listener to tell me somebody that doesn't use AI in some kind of way.
Yeah. Now, that doesn't mean AI utilization is at its peak. It doesn't mean that it is now fully integrated into society. We're nowhere close to that. But we're at a level, according to George Mason University, where there's 40% of U.S. adults already using generative AI and enterprises integrating AI into their workflows. So there's genuine demand. It's not just recycled capital that's going on, according to the MIT paper. And then you get the scaling is a lot easier with AI because you already have some infrastructure. You have PCs, you have the internet, so that's accelerating the adoption. .com firms didn't have a utility at the beginning. It was just, you just had a bunch of companies that put .com at the end of their names, and all of a sudden, it's the new economy. Whoa. Right? It's the new economy. I remember that distinctly in the late 90s. Oh, these are new economy stocks. Oh, we don't want to invest in old economy stocks, like companies that make soft drinks. We got to invest in pets.com that makes what? Nothing. So, and then there's, of course, policy implications. There has to be an encouragement of adoption, and that's occurring right now. Now, there's, of course, consequences of all of this, positive and negative. Operational efficiency, productivity is expected to skyrocket. On the other hand, the question is, what happens to the labor that's displaced? Well, like every other technological innovation in human history, that labor finds another purpose. And I don't know exactly what that purpose is going to be for the people who are displaced by AI, but the nature of humanity has historically been we adapt to change. And I'm sure there will be an adaptation, but we can't wring our hands over what's going on right now. The MIT paper talks about the small ecosystem, the circular funding, real world utility is too slow, the loop could collapse.
I don't even know where. I mean, I don't even know where they get the idea that real, utility is not expanding like crazy. Because I mean, you mentioned it, John. We all have PCs. We all have phones. My phone has gotten smarter over the last 2 decades.
Too smart.
It's gotten smarter maybe than me. Okay, it scares me. I'm holding a brain that's bigger than mine in my hand.
You're thinking of buying a bike, and all of a sudden you see all these things coming up on your feed. Oh, look at that.
Yeah, no,
look at that Kawasaki that keeps coming up.
We don't. You can't even talk about accelerated adoption right now, because you're right. The .com era, there were no utility. There was no utility. It was like everybody was really truly speculating on what could be, what might be, and what I see now is that what is.
We are probably in the first inning of the AI cycle. We are in the foundational period where literally the foundation is being constructed. You're pouring cement into the ground to get that solid foundation. You're starting to put up the frame of the house. And that's the phase we're in right now. The fact that initial participants, like in every other technological innovation, it attracts participants. There were, I think, I don't know how many exactly, but a couple hundred car companies when the car was invented. How many survived? 2, 3 in the United States? So yes, we understand the fact that during this period, there's going to be an initial phase where there's a lot of initial potential for profit and prosperity, and a lot of participants come in. But then there's going to be a fallout period where the marginal players lose out. And so this is where it becomes critical to be very picky about your investment selection. You can't just uniformly buy every AI company out there or every company that feeds into the AI system. You need to be very careful as to which companies you select. For all we know, these magnificent 8 stocks that exist today, maybe only 4 will survive. Maybe only 3 will survive. Maybe Google buys Meta,
right,
eventually, that type of thing. So yes, there is a phase. So you get the initial build out, you get a lot of initial prosperity, then you get excessive competition, you get a collapse in prices, and then you get into the second phase. And I think that's what a lot of people are saying is, we don't want to be part of that big collapse in price after the initial phase. Well, this is why you need to be careful. This is why you need professional management. This is why you can't listen to newspapers to make investment decisions.
I think it's also important to understand, and when you say it's in the first inning, part of the reason why we're more than likely in the first inning of AI is because we haven't even gotten to that point where there's an excess of different participants. It has really been a largely concentrated play in terms of the companies who are heavily involved in the space and who are dominating the space right now. And so that is very typical of early phase adoption for any new technology or any new business or industry, is you get an early level of concentration, and then you get a democratization of the technology or of the intellectual property or whatever it is, the business that is going through its development phase, that allows additional players to come in. And they drive the price down, and it creates a more level playing field. And then you get, like you said, some of the peripheral players will get culled from the herd, and then you'll end up with the ultimate survivors. Right now, it has been largely dominated by the United States and the U.S. market. We haven't even really seen any major global competitors. We had the DeepSeek, 5 seconds of glory in February, but other than that, China and the EU have really not made a major dent in this industry at this point.
EU innovation is an oxymoron.
No.
How much
yes.
innovation occurs in the European Union? They are so overburdened by regulation and taxation and big government.
They innovate and new ways to regulate and tax everybody to death.
A fourth layer of government, municipal, regional, state, and then you get the
Continental.
The continental government, the fourth level of government. So everyone wants to work for the government. So EU is going to have very limited innovation. China is in serious financial trouble. Contrary to everything we hear in the press, they have completely overbuilt the real estate sector. Their credit is very much extended in China. A famous hedge fund manager in the U.S., Jim Chanos, has said the credit bubble in China is the real issue here, and they're over indebted. You know, we talk about debt to GDP ratio of the U.S. and Europe, et cetera. China's debt to GDP ratio is no worse than the U.S. or no better than the U.S. So they're not exactly having an easy time, and they're a centrally managed economy. And we know from experience historically that central planning doesn't work to run an economy. Just take a look at Cuba or North Korea. Take a satellite image of North and South Korea at nighttime and see how many lights are on in North Korea versus South Korea. You need free markets to function. That's what's going to create wealth. But so what do you do about it as an investor? Okay, so we've talked about how perhaps AI is not really a bubble, or maybe it will become one day. Maybe when as Alexander noted, when democratization occurs and other competitors come in, there might be a drop in price. So what do you do as an investor? Well, I pulled up some of the biggest large cap mutual funds in the United States. Fidelity Blue Chip Growth, Fidelity Contra Fund, JP Morgan Large Cap Growth, T. Rowe Price Blue Chip Growth. These are all very, very large mutual funds, and one of these is an ETF. So let's take a look at their top holdings. Well, I'm going to save us a lot of time. It's the Magnificent Seven stocks in each and every case. And the biggest holding for Fidelity Blue Chip Growth is NVIDIA. It's 16% of their portfolio. That's huge. Then you look at Apple is 9%, then Microsoft 7%, Amazon 7%, Alphabet 5%, almost 6%. So you add those up, and roughly half the portfolio is in 5 stocks. So there's a concentration risk there. You get a similar situation with Fidelity Contra Fund, the biggest mutual fund in the U.S., 15% in Meta Platforms. And then you add the rest, NVIDIA, Berkshire, which is not a Magnificent Seven stock, Amazon, and Microsoft. Again, 5 stocks, getting close to half the portfolio. And JP Morgan Large Cap Growth, same story. Biggest position, NVIDIA, 12.5%, Microsoft, over 10%. And you look at T. Rowe Price, NVIDIA, 15%, Microsoft Corp, 13%. And then you look at us, at our portfolio. And our portfolio, in the top 5, we hold one of the Magnificent Seven stocks, just one. And our allocation for any stock in our portfolio does not exceed 5%. So we're not overly concentrated in any one security. We're nicely spread out. Among our top 5 stocks are 2 other companies in there that are involved in the infrastructure of AI, but they're not those big Mag 7 stocks. And then we have a couple of healthcare companies, which are growing and doing quite well. So, you know, what the average person needs to do is understand what their investments are, how they're structured. If you're in an institutional investment, like any of the big banks here in Canada, or Fidelity in the States, or the big banks in the States, they're going to be basically replicating the S&P 500 index. And the way they try to outperform is by overweighting 2 or 3 companies. The way we outperform is by identifying solid businesses and high quality businesses. When we say high quality, we're talking about the financial fundamentals and relative strength. And as companies lose their relative strength or their financial fundamentals deteriorate, we're going to move out and change. And so our portfolio is constantly evolving and changing. And that's why we're the leading portfolio manager in North America for the last 2 years. And it's the process that matters. And so you need to pay close attention to where you're invested, who's managing your money. If it's an institution, chances are you're going to go for the AI ride. Good or bad, you're going for that ride. But if you're with someone like us who think outside the box, who think independently, objectively, and don't pay attention to the media, then you're going to get a uniquely structured portfolio that's going to benefit in all market cycles.
And that sounds like a perfect place to wrap this episode up, as a matter of fact. And for those of you who are listening to this conversation who don't have a relationship yet with John and Alex, maybe you should. Maybe you should reach out to them. Maybe you should give them a call, check in with them, and maybe have a conversation. And John, Alex, what is the best way for someone to do that?
The best way for somebody to do that is to send us an email at info@medwealth.ca. That's info@med-wealth.ca, or visit our website at medwealth.ca.
Fantastic. And if this conversation has done what I think it should have, you probably want to subscribe to the podcast at the very least. If you're not a subscriber, that part's really easy. Just hit the follow button. The beauty of that is that every time they drop a new episode, you're notified. You can give that one a listen as well. And in fact, before we get out of here, what is the next episode about, guys?
The next one is going to be Confessions of an Entrepreneur with Chris Reynolds. He is the one of the co-founders of our licensing firm, IPC Securities. So he will be providing his insights as an entrepreneur, how he started the business, and give our listening audience a great level of perspective as to what's required and what it takes to build a business from the ground up.
On that subject, Bill, we encourage everyone listening to this particular episode to go back to episode 53, Building Wealth Through Concentration. It is one of our most popular episodes because we articulate our process and how we have been able to achieve these extraordinary gains over the last couple of years. So we really encourage everyone to listen to episode 53 of the Prescribing Prosperity podcast. And we have 54 episodes already in the can, several others that are being processed. And we encourage everyone to go to our to our podcast platform homepage and take a look at the list.
Yeah, it's a great list. It's a great series of topics. So as we get out of here, I want to do one more thing. If you like this podcast, give it a like. Tell people about it, please, because word of mouth promotion is invaluable. You know, we all get all the online recommendations driven by bots that have a clue who you are or what you do or what you're really interested in. They just see what you kind of look at on the internet. Word of mouth promotion from another human being to another human being is the most invaluable tool of promotion on the planet Earth, and will always remain so. So please do that. All right. Well, it's that time. We got to go. I'm Bill Tucker on behalf of John and Alex and everybody at MedWealth Financial. Thank you so much for listening today, and we'll catch you next time.